Hello friends, very good morning. This is Sacharazu Koluru. I'm here to teach total 3 topics. Number 1 is exclusively for amalgamation, and the other one is internal reconstruction. And the final chapter is liquidation of companies. Before proceeding with further, first of all, sir, how you are going to deal these entire 3 chapters, sir? Hope you already received the material. By yesterday night itself, I placed relevant material for all the chapters, which is in PDF mode, was uploaded. Please, all of you go to your material corner and download it before proceeding with further. Sir, apart from the main material, I also provided a solution copy for the problems, because the time is pretty much less for us, but volume wise the chapters covers vast syllabus. It is not possible to cover each and every problem by working in the classroom itself. That's why whenever time permit to me, I'll go through certain solutions from solution material as well. So that's why it's my sincere request to the entire students, please all of you make it, download it from solution material itself. Guys, let me know all of you through query box. My voice is clearly audible and you got the materials. Am I right? Can I proceed further? At least some members, if you provided thumbnails or something, then I can able to understand you are at par with me. Let me know, guys, quickly. Yes, sir. Fine. Superb. So at any point of time, if you have any doubts or any queries or anything, just to make it, put it under your query box. Then I can able to see. In between the class, don't disturb me. So I will provide certain time to you. So at that point of time, I'll definitely resolve your doubts. But whenever you got such doubt, just put the doubt in the query box. I'll read the doubt, but I unable to resolve at the same time, but I can able to resolve at the appropriate time. Is it okay, guys? Fine. Superb. Now, all of you, please participate with me. Guys, do you listen the word reconstruction at any time in your life? I'm not talking anything about our accounting or something related to other things. Just in your common parlance, anytime do you listen the word reconstruction? What does it mean? What does it mean? Sir, we generally listen the word reconstruction in case of structures or buildings. Am I right? Yes, that's correct. Now, here my problem is, sir, I have a building, I have a construction, or I have a building. The problem is the existing building is not suitable for either residence or either for commercial purpose. What is the reason, sir? Maybe certain disturbances internally happen because due to age or maybe due to any other issues. I mean, lack of proper colors. Lack of proper colors is one of the reason, or maybe in rainy season the rain falls into the house, maybe due to damages occurred in the house. Okay, maybe holes or something like that. Okay, so these are certain problems faced by me from the current building. Then can you please let me know, all of you, what are the solutions we have to recover from that situation? Anyone, please, all of you quickly participate. What are the solutions we have? I think so we have two better solutions. One is either we can demolish the existing building. Demolish the existing building. Altogether, you can go for new construction. That is one option is available. If you thought that existing building is not at all suitable for your purpose. Sir, another option available with me is, sir, don't go for demolishing. You can go for renovation. Renovation without demolishing. Do you agree, guys, all of you? There are only two options available with me. If I want to use that particular building, either I can demolish the existing building, I can go for the new construction, or else I should need to renovate the existing building according to my structure by going for painting and all other stuff. Am I right? Now, let me know, if I selected first option, what are the advantages available to me? What are the disadvantages? The advantage is, if the existing building was demolished and altogether I can go for new construction, then the first and foremost advantage is, which is a new building, right? So new buildings are always having the huge brand loyalty. So anyone can easily like such building. The disadvantage is, it involves huge construction cost. Am I right? If I go for the renovation, what is the advantage for me? The advantage is low construction cost. Yes, if you go for the renovation, the major advantage is the construction cost is pretty much less well compared with other option. Then what is the disadvantage? Sir, anyone can easily identify that which is the old building. Even though if you renovated by applying certain colors, if you're adding certain other materials, then it doesn't lose their old structure, right? So people can easily identify that which is the old structure only. That means the disadvantage itself is brand loyalty. People can easily identify, even though if you made certain additional value addition to the building. Do we agree, all of you? Do you agree? So many of our friends have a doubt that, sir, is it accounts class or something related to civil classes? No, it is accounting class only, guys. I'll connect just a moment. If you take financial position, if you take a financial position of a particular company, if you are facing certain problems with the financial position of that company, how you went for reconstruction of the existing building, in the same manner you can go for reconstruction of the company. I mean, how you are going for demolishing and construction of a new building. Sir, can I liquidate the existing company and go for incorporation of other company? What you are talking? Yes, absolutely true. Sir, without liquidation of existing company, internally can I made certain modifications within the company? Yes. Sir, for which purpose you are doing all these things? You are facing certain problems within that company. Then you are opting for reconstruction. First, let us see what are the problems faced by the company. What are the reasons are triggered to go for the reconstruction? Do you understand, all of you? Now let me open financial position of a particular company. Hope it is visible, guys. All of you, right? So sometimes I'm using this PDF as well. As I know, as I already told you, so to save my time, I am unable to write each and everything, even though these classes are regular classes, but the number of sessions given to me are very much less, but the syllabus is used. That's why certain times I'm going to use this PDF material as well. But the entire material I'll send it to you at the end of the sessions. This PDF material, this is the entire written notes by me, but at this point of time I am unable to send. I already sent the main material as well as solution material except this PDF material. So I'm using the same PDF material for classroom discussions. At the end of the classes I'll send it. Don't worry, please all of you apply your mindset and please put your mind on the class itself. Don't make it write anything. Okay, fine. Now this is the balance sheet of Rani Limited. So balance sheet of Rani Limited was given as at 31st March 2020. Now if you observe the balance sheet, share capital, we have equity share capital 1 lakh equity shares at the rate of 10 rupees each, which is 10 lakhs. We have preference share capital 10,000 preference shares at the rate of 50 rupees each, which is 5 lakhs. Under non-current liabilities, debentures are there, 10% debentures. Bank loan is there for 2,50,000. and the other part is current liabilities, and total of equity and liabilities comes to 27,50,000. Now, if you come to assets part, PPE is there for 10 lakhs, intangible assets exist for 4 lakhs, current assets is there for 5 lakhs, profit and loss account debit balance. Sir, what is the meaning of profit and loss account debit balance? Which is the loss situation. The company is suffering from losses since few years, and the miscellaneous expenditure not written off. So, which is a fictitious asset, which is not the real asset, which is a fictitious asset. Now, the total of the assets is 27,50,000. Now, here I am asking one question. Please, all of you participate. Do you think that, sir, the real worth of assets were 27,50,000 in balance sheet, even though it is showing at 27,50,000? Do you think that in outside market the real worth of assets will be 27,50,000? Tell me, guys. No, absolutely no. Do you know the reason? Sir, out of this 27,50,000, miscellaneous expenditure not written off will be there for 2,50,000, which is a fictitious asset, which is not a real asset. It doesn't have any market value in the outside market. And one more thing, profit and loss account debit balance, which is a loss situation, sir, which doesn't contribute anything in the outside market. And moreover, if you observe here, even though intangible asset 4 lakh is there, I clearly wrote it is an unrepresented asset. Unrepresented means, sir, for books only, we have the intangible asset, but really it doesn't have any value, sir. For example, goodwill. In such intangible asset, one of the asset is goodwill. The enterprise itself is a loss-making company. Then how you can thought that we have goodwill? For namesake, we are having goodwill in the books of accounts to the extent of 4 lakhs. But really, do we think that in the outside market, our entity is attaining any goodwill? No. That's why the existing financials of Rani Limited not depicting true picture. The financial statements are not depicting true picture. Sir, what are the reasons? There is a overvaluation of assets. Due to overvaluation of assets, there may be a chance of overvaluation of net worth. Now, to show the financial position of Rani Limited in true and fair view manner, now the Rani Limited can go for reconstruction. Now Rani Limited is facing certain problems with their existing financials. The financials are not showing in true and fair view manner. To depict such financials, to convert such financials in true and fair view manner, we can go for reconstruction. Now such reconstruction is going to happen in two different ways. One is by liquidating the existing company, that is liquidation of Rani Limited. Liquidation of Rani Limited. Why Rani Limited is going to liquidate? Another company so-called Razu Limited is going to take over the Rani Limited. Razu Limited is incorporated on behalf of Rani Limited. Then what Razu Limited will do, sir? Simply, Razu Limited will take over the correct value of the assets, or the assets with correct values. PPE, for example, it is in books 10 lakhs, but in the outside market, if it is at 8 lakhs, then Razu Limited is going to take over PPE at 8 lakhs only. This intangible asset doesn't contribute any value. That's why Razu Limited will not take these intangible assets. Current assets also will be take over at the correct value. P&L account is a loss, no one can take in. Miscellaneous expenditure not written off is a fictitious asset. Razu Limited will not take that asset. Now, out of the capital and liabilities, Razu Limited will only take over the liabilities. So then what about equity and preference share capital of Rani Limited? That doesn't take over by the Razu Limited, because Razu Limited having their own capital, or Razu Limited is ultimately purchasing Rani Limited. Do you understand, all of you? Razu Limited ultimately purchasing Rani Limited. As a result, Razu Limited will pay something which is technically known as purchase consideration. Here Razu Limited purchasing the business of Rani Limited in the form of assets and as well as liabilities. As a form part of consideration, it will pay something either in the form of cash or either in the form of equity shares or preference shares. Now such equity shares or preference shares will become as share capital to the Razu Limited. So that means what is happening really here, sir? Now the existing structure of Rani Limited is slowly converting into the Razu Limited, and the main objective of reconstruction is satisfying by showing the assets and liabilities at their true values. If like this Rani Limited adopted, then the particular reconstruction is known as external reconstruction. External reconstruction. Sir, now Rani Limited don't want to adopt the external reconstruction, sir. It don't want to liquidate. Just it want to continue their existing business with the same name. That means Rani Limited is going to continue with the same name without liquidation. Without liquidation. Then what happens, sir? All of you please concentrate here. Then what happened? Rani Limited will go for internal reconstruction. Internal reconstruction. Now, if you observe, in case of second option, without demolishing the existing building, we can go for renovation, right? Here also internally we can go for renovation. How it is going to happen, I will tell you. In case of internal reconstruction, first of all, the company should go for, just a moment. The company should go for court approval. Yes, sir, our company financial position is not showing a true and fair picture. Just we want to go for internal reconstruction. It will make a play to the court of law. It will then court may accept or court may reject. If court may provide the approval, then after getting the approval, the company can go for internal reconstruction process. In such internal reconstruction process, really what happening, sir? Just outline I'm telling. We are elaboratively discuss such all issues in deeper manner in our all further classes. But what really happening in the bird's eye view, here I'm explaining. Sir, once the court approved, what we will do, here profit and loss account, we should need to vanish. We should need to remove, because which is a loss making company, which is not a real asset. This miscellaneous expenditure not written off also, just I want to remove. Now the PPE, intangible asset, current assets are not showing at their real market values. Either I can go for revaluation of assets. Such revaluation may be either upward revaluation or maybe downward revaluation. Sir, how you can remove P&L account miscellaneous expenditure not written off? Just now I crossed, like that you unable to remove, na? I required certain profits. Now the profits which I derived from the internal reconstruction, I can able to set off with the losses as well as fictitious assets. Then how I can able to derive the profits from internal reconstruction? If you go for revaluation, if you're having any chance to make it upward revaluation, then due to such upward revaluation, you are retaining certain profits. Such profits you can utilize to set off this P&L account as well as miscellaneous expenditure not written off. And you should also go for negotiation with various parties, either those are the liability holders or the capital contributors. I mean to say, you will create or you will conduct an equity shareholders meeting. Then you can clearly explain the situation and you can ask that now the existing face value per share is 10 rupees, right? You should need to sacrifice to the extent of 3 rupees out of 10 rupees. Now each and every equity share I'm going to convert into 7 rupees. Due to sacrifice made by the equity shareholders, we are retaining certain profits. 3 multiplied with 1 lakh, that 3 lakh is again profit. Again, in the same way, we are making a compounding activities with other liability holders. That is either bank loan or with the debentures. Then we are retaining some more profits. Then you may have a doubt that, sir, how the other parties will simply agree for that? If our company go for the liquidation, then these liability holders will not get any money. Because whenever a company go for the liquidation, with the available cash flows only, company can able to repay the amount to the other stakeholders. Either those are the loan parties or either those are the shareholders. Rather than going for the liquidation, just we are trying to convert the existing financials into the true and fair view manner. That's why definitely they will agree. And moreover, such all entire terms and conditions will not happen as on a single day. So as a number of days, we are making a negotiations, we are conducting various meetings. So based upon the entire curriculum, based upon the entire design, we ultimately go for internal reconstruction. Now, whatever the profits we are attaining through the upward valuation of assets, sacrifice made by the shareholders, and compounding activities made with the various liability holders, ultimately such profits we are utilizing to set off the profit and loss account debit balance, as well as fictitious assets, and as well as unrepresented assets like intangible assets. Then automatically the existing financial statements will show true and fair view manner. If the company is going to adopt that procedure is technically known as internal reconstruction. Now, can you please tell me, all of you guys, do you have the broad view of external reconstruction and internal reconstruction? What really happening in case of external reconstruction and internal reconstruction? Do you understand? Tell me, guys. One of our friend is asking, sir, what exactly mean by fictitious assets? Oh, my dear, fictitious assets means those assets which doesn't have any real value. For example, preliminary expenses not written off is a fictitious asset. Discount on issue of debentures is a fictitious asset. Actually, right now, there is no place for fictitious assets in the balance sheet as per Schedule 3. That is altogether different story. Whatever the fictitious asset we derived in the current year, the entire fictitious asset should be charged to the P&L account in the year of occurrence itself. But just for understanding, here I adopted. Is it okay? Hope you understand the meaning of fictitious asset. Fine, right? Yeah. Now, let me know, guys, all of you, what are the advantages if I followed the external reconstruction? What is the disadvantage? In the same way, what are the advantages and disadvantages in case of internal reconstruction? Please, all of you, let me know quickly in the chat box through your answers. What is the advantage in case of external reconstruction? Altogether, a new company is incorporated, na? So definitely for the new company, brand value is high because no one is thinking about Rani Limited. From onwards, all the people can able to see the Razu Limited only. What is the disadvantage, may I know? What is the disadvantage? Sir, the company is suffering from huge losses right now itself. If you can go for the new incorporation, then huge incorporation expenses you should need to incur, right? For the purpose of incorporation of a company, you should need to pay the legal fees to the MCA. You should need to raise the capital again. If your company is a listed company, then again shares should need to be listed. You should need to entering with the stock exchanges as a listing agreements. Am I right, guys? So disadvantage is huge incorporation related expenses. That is disadvantage. Now coming to internal reconstruction, what is the advantage? That is cost is less while compared with the external reconstruction. The reason is the existing Rani Limited is not going for liquidation process. The same company is going to continue. The disadvantage is while seeing the Rani Limited, everyone can easily find that, sir, earlier the company is facing severe liquidity crunches as well as facing certain financial problems, and which is a loss-making company. How they can easily find out, sir? After completion of internal reconstruction, Rani Limited should need to add the word and reduced while preparing the financial statements. I mean to say, at the time of presentation of balance sheet of Rani Limited, after completion of internal reconstruction process, it will add the word and reduced. If anyone's seen this and reduced word, they can easily understand that, yes, Rani Limited is a loss-making company. By making certain internal reconstruction process, by adopting certain internal reconstruction process, now the company financials are showing the true and fair picture. So that's why they can easily identify that previously the company is a loss-making company, which is a disadvantage. That is, the brand loyalty is poor while compared with the external reconstruction. These are the advantages and disadvantages. Now, one more thing. Internal reconstruction, company's information may not go out of the business. In external reconstruction also, internal information will not go to the out of the society, guys, because even the new company is incorporated, what you are thinking, this new company doesn't contain any new shareholders. In fact, the same shareholders of the Rani Limited will become the shareholders of the Raju Limited as well, in case of external reconstruction as well. In both the cases, either external reconstruction or internal reconstruction, the information doesn't go to the out of the society. But after completion of internal reconstruction or external reconstruction, definitely you should need to share the information with the public, because here a lot of public money is going to involve. Am I right? Fine. Sir, one doubt. Why was profit or loss on asset means? Mr. Muhammad, what you want to ask? I can't understand your language. Can you please ping me once again? Okay. Any other doubts before going to further? Because once I'm entering into the next concept, I am unable to look back for approximately 30 minutes. Let me check quickly. Yes. Okay. Guys, this is the first class you are listening, right? Tell me you are able to listen the speed at which I'm teaching. It is okay for you, right? Can I continue, or can I make it much more speed, or can I make it much more slower? Give your comments quickly. Or is it enough? It's good, sir. Please follow the same flow like that quickly, guys. Before proceeding with further, please all of you participate. 100% participation should be required for me. Yeah, same speed you can continue, sir. Okay. Very few members are participating here. What about others? Yeah, superb. Yes, so many answers I got. Fine. Now, just a moment, guys, all of you. Sir, you told that you are dealing total 3 chapters. One is amalgamation, and the other one is internal reconstruction. And finally, you also deal liquidation of companies. Now, your doubt is how the chapter amalgamation is having interrelation with this external reconstruction or internal reconstruction, sir. Actually, we are in the chapter amalgamation. Then why you are discussing external reconstruction and internal reconstruction? Amalgamation is a classic example for external reconstruction. Amalgamation is a classic example for external reconstruction. In fact, amalgamation in the nature of merger. Amalgamation in the nature of merger is a classic example for external reconstruction. First of all, if you want to understand this thing, first you should need to know 3 different concepts. What are such concepts, sir? What is the meaning of amalgamation? What is the meaning of amalgamation? What is the meaning of absorption? What is the meaning of external reconstruction? External reconstruction. Concentrate, guys, all of you. In case of amalgamation, what happens? A Limited, B Limited, 2 companies exist. Now A Limited, B Limited, together just they want to form a new company, which is AB Limited. A Limited is a existing company, one existing company. B Limited is another existing company. Altogether, AB Limited is a newly incorporated company. A newly incorporated company want to take over 2 or more existing companies, then such process is known as amalgamation. Now coming to absorption, please first of all let me continue the 3 concepts, then I will summarize what really happening and how we differentiate with each other, then why we are discussing these concepts as well. Okay. In case of absorption, one existing company is ready to take over another existing company. This is one existing company. This is another existing company. One existing company is ready to take over another existing company. Simply here, B Limited is ready to take over A Limited. Then such process is known as absorption. In case of external reconstruction, what will happen? A new company is incorporated. B Limited is altogether a new company, is incorporated to take over the business of A Limited. To take over the business of A Limited. Now A Limited is an existing company. The same thing was happened in our above case. What happened? Rani Limited is an existing company. Now we incorporated the Razu Limited. Am I right? Here, if you check where the example is, yeah, here it is there. Rani Limited is an existing company. Then we incorporated Razu Limited to take over the business of Rani Limited. Now, if you observe in case of external reconstruction, a new company is incorporated, which is Razu Limited, to take over the existing business of Rani Limited. Here, B Limited is incorporated to take over the business of A Limited. Now, if you observe all of you, in case of amalgamation, what happened? A newly incorporated company is ready to take over 2 or more existing companies. That means to set a particular nature of conversion is known as amalgamation. Minimum 3 companies should need to involve, out of which one company is a newly incorporated company. A newly incorporated company is ready to take over 2 or more existing companies. Then such process is known as amalgamation. In case of absorption, an existing company is ready to take over another existing company. In case of external reconstruction, a newly incorporated company to take over the existing company. Now coming to the objective, sir, why they want to do like that, sir? You already know the objective in case of external reconstruction. What is the objective in case of external reconstruction? Tell me guys, all of you. To show financial statements in true and fair view manner, because the existing financials are not depicting true picture, true and fair view manner. Because the existing financials are not depicting true and fair picture. That is the reason why people are go for external reconstruction. We know that, right? Now, what are the reasons for amalgamation and absorption, sir? The reason are the objects of amalgamation, absorption are maybe to avoid competition. Yes, to avoid competition. Maybe to get the synergy benefit. To get the synergy benefit. Maybe economies of scale will work out. Economies of scale. Do you understand? I'll give a classic example. Let us assume in soft drinks industry, 2 big companies are there in the worldwide. You know, one is PepsiCo, another one is Coca-Cola. Am I right? Tell me, yaar. PepsiCo and Pepsi and Coca-Cola. Now, if one company wants to avoid the competition, then the company want to simply absorb the other company. Then automatically competition will avoid. To get the synergy benefit, what is the meaning of synergy benefit, sir? 1 plus 1 always greater than 2. 1 plus 1 is always greater than 2. Sir, in mathematics, we learn 1 plus 1 is equal to 2 now. Then 1 plus 1, how it will becomes greater than 2. For example, one company is good at manufacturing and the other company is good at marketing. Now, in the earlier situation, one company sales and the other company sales put together. Now, after the completion of either absorption and amalgamation, the sales will be automatically much more. The reason is now they are applying their own skill set to develop the further sales. because right now manufacturing is good, marketing is also good. So that's why definitely the sales are much more in increased manner while compared with fast. That is the reason why I told you 1 plus 1 is greater than 2. And economies of scale. Now, due to merging of two enterprises, definitely we will save certain costs. Earlier, 2 admin offices we should need to maintain. Right now, only 1 admin office. Then earlier, 2 times we should need to pay the audit fees. Right now, only 1 time. Like that, certain fixed cost we may able to save. And due to the huge production, and the cost per unit will also going to decrease if you apply the techniques of the costing. Am I right? And one more thing, I have one doubt. Sir, for example, A Limited is an existing company which is a loss-making company, but still B Limited want to acquire the A Limited. What is the reason? Sir, A Limited is a loss-making company. Then why you want to acquire the A Limited right now? B Limited is a profit-making company. Super abnormal profits are generated by the B Limited, but still B Limited want to acquire the A Limited. Do you know the reason? What is the reason, guys? Can you please let me know quickly through the chat box? Quickly. What might be the reason? Anyone, can you guess it? No one is providing here. Still I am awaiting. Maybe there is a delay in network, I think so. You might already sent. May I know what might be the reason? It's very simple, guys. To get the taxation benefits. Taxation benefits. Sir, if B Limited is a profit-making company, huge tax burden is there on B Limited. Once B Limited is acquired the A Limited, then the loss suffered by A Limited are automatically nullified with the profits generated by B Limited. Then the tax burden on B Limited was decreased drastically. Maybe not only that, just I'm telling in that particular mode, might be A Limited will have certain group of assets. Even though A Limited is a loss-making company, A Limited, if you are analyzing the past trend, it might have the capability of manufacturing abilities, or it might have the capability of employee resource, or it have the good market share in the other countries. We don't know, due to any other reason. That is the reason why, even though one particular company is a loss-making company, then the other company is interested to take over. That's okay, sir. Fine, we understand. Now, here you should need to know one thing, guys. The objective of external reconstruction is quite different from objective of amalgamation and absorption. In case of external reconstruction, the primary objective is only to show the financial statements in true and fair view. That is the reason why people are just go for external reconstruction. But in case of amalgamation and absorption, people thought process or the people objective is not to show the existing financials at true and fair view. Their thought process is either to avoid the competition, or to get the other benefits, or to get the economies of scale, or to get the taxation benefits, or maybe with any other motto, people can go for the amalgamation and absorption. Then you may have a doubt that, sir, why you are combining the concept of amalgamation, absorption, and external reconstruction at a single stretch? Both the objectives are different, na? Objectives might be different, but accounting treatment is same. That is the reason why combinedly I am put together 3 concepts. In case of amalgamation, what happen if you observe? There are 2 set of companies exist. One is purchasing company, AB Limited. A Limited and B Limited are the selling companies. Do you agree? Now A Limited liquidate. Just it sold their all assets to AB Limited. B Limited is also going to liquidate, and B Limited is willing to sell all their assets and liabilities to AB Limited. So now A Limited and B Limited are selling companies. AB Limited is a purchasing company. Now in case of absorption, what happened? Sir, B Limited is one existing company, is ready to take over A Limited. Now B Limited is a purchasing company. B Limited is a purchasing company and A Limited is a selling company. Tell me the same thing is going to happen here as well. One purchasing company, one selling company is there. That means only 2 different set of companies are there, purchasing and selling companies. Now, if you go for external reconstruction, again, a new company is incorporated to take over the existing company. Such a new company is a purchasing company, and the existing company which is going to liquidate is known as a selling company. Sir, that means whether you go for amalgamation, whether you go for absorption, whether you go for external reconstruction, only two different set of companies exist. One is selling company and the other one is purchasing company. Do you agree, guys, all of you? Do you agree? Fine. Sir, selling companies here we have are selling companies we may call with different names. Sometimes the selling companies are also known as vendor companies and the purchasing companies is known as vendee company. And coming to amalgamation, we may also call it as amalgamating company. Amalgamating company. Now purchasing company is known as amalgamated company. Amalgamated company. So like that with various names we are calling, whether it is selling company or vendor company or amalgamating company, whatever the name you can call, the company is going to liquidate. Such company is a selling company. Now either vendee company or purchasing company or amalgamated company, whatever the name you can call, that company is a purchasing company, is going to purchase the business of the other company. Such company doesn't go for liquidation. The other companies only go for liquidation. The same concept you can apply either in case of absorption or external reconstruction as well. Is it okay to all of you? Guys, let me know all of you. Hope you can able to differentiate the concept of amalgamation, absorption and external reconstruction with their objectives, with their structures, what really happening, which companies are going to liquidate, whether it is an existing company or a newly incorporated company, whether more than two companies are involved or whether only two companies are involved. Like that you can differentiate with each other, right? Fine. Please give example from real world of all three cases like Tata acquired Air India. That's fine. I can able to give real-time examples as well, but this is not relevant time for that because lot more we should need to concentrate at the end of amalgamation and internal reconstruction as well as liquidation of companies chapter over. Then I'll take the real examples. What really happened in that particular companies, I'll show you. Okay, one of our friend asked, Mr. Manoj Kumar, sir, can you please give certain real-time examples? Okay, I'll definitely give the real-time examples at the end of our sessions or in between the sessions as well. Okay, for the time being, please let me continue. Yes, clear. Now, guys, first let me discuss something related to types of amalgamation. Types of amalgamation. Please concentrate, all of you. So let me discuss something related to types of amalgamation. And one more thing here I should need to highlight. For the purpose of providing accounting treatment, amalgamation includes absorption as well. Whenever I'm talking the word amalgamation, back of your mind, you can also include absorption. You can also include absorption. You can also include anyway external reconstruction because as I already told you, one particular type of amalgamation, we can call it as external reconstruction only. Amalgamation in the nature of merger is straight away a classic example for external reconstruction. So that's why whenever I'm talking or whenever I said amalgamation, back of your mind, it includes absorption as well as external reconstruction. Because for accounting treatment, I doesn't see differently. I unable to see any difference among those three concepts. So just like that, you can consider amalgamation, absorption, external reconstruction in the same way. Why I am emphasizing at this stage, so many students might confuse at the time of resolving the problems. Sir, if it is absorption, then what procedure I should need to adopt? Then if it is external reconstruction, is that any other procedure I should need to adopt? Like that, please don't think. Whether it is amalgamation, absorption, or external reconstruction, there is no change in accounting treatment. For objective wise, structure wise, there may be a difference, but for accounting treatment wise, there is no difference. Okay, fine. Please come below, all of you. Types of amalgamation. First, let me discuss. You know, there is a standard, one standard, which is accounting standard 14. Accounting standard 14 stands for accounting for amalgamation. Am I right? As per the existing accounting standards, not as per the Ind AS. So Ind AS is altogether different. So Ind AS will discuss things related to the reconstruction related things, but AS 14 is only covers exclusive part of the amalgamation. Based on that AS 4, amalgamation is broadly categorized into two types. Amalgamation is broadly categorized into two types. One is amalgamation in the nature of merger, and the other one is amalgamation in the nature of purchase. All of you please concentrate. Amalgamation is broadly divided into two types based on AS 14. One is amalgamation in the nature of merger, and the other one is amalgamation in the nature of purchase. Now here my question is, when amalgamation is said to be amalgamation in the nature of merger, when a particular amalgamation is said to be amalgamation in the nature of purchase? That is the matter of discussion here. Concentrate. If all the following conditions or all the below conditions satisfied, all the below conditions satisfied, then that particular amalgamation is treated as amalgamation in the nature of merger. If any one of such condition not satisfied, if any one of condition not satisfied, then that particular amalgamation is known as amalgamation in the nature of purchase. Then what are such conditions, sir? Then what are such conditions? Please concentrate. Let us take two companies exist. One is A Limited and the other one is B Limited. Sir, B Limited is a purchasing company. So A Limited is a selling company. Now what are such conditions, sir? Number one, to said an amalgamation is amalgamation in the nature of merger, all the assets and liabilities of the selling company should need to transfer to the purchasing company. All the assets, not only the assets, liabilities as well. All the assets and liabilities of selling company should need to transfer to purchasing company. Sir, that means, for example, A Limited will have one building, sir. Except building, A Limited will transfer all the assets to the purchasing company. Then will it call it as amalgamation in the nature of merger, sir? No. All the assets, what I said, including cash, so including current assets, including debtors. Do you understand? Liabilities, including the bank loan, including the debentures, whatnot, everything. Every asset and liability of the selling company simply transfer to the purchasing company. Number two, all the assets and liabilities of selling company should need to transfer to the purchasing company at the rate of book values only. Book values means, for example, in A Limited, just what we seen here itself, right? Here we seen, right? Now PPE is having 10 lakh book value. Now Razu Limited is ready to take over Rani Limited. Now Rani Limited is going to sell this PPE is also at 10 lakhs. Now this current assets is at 5 lakhs. Now Rani Limited need to sell these current assets also at 5 lakhs. Now all the assets and liabilities of the selling company should need to transfer to the purchasing company at book values only. If you sell at the rate of book value, then I can call it as amalgamation in the nature of merger. Other than book value, if you sell, then I can call it as amalgamation in the nature of, tell me guys, amalgamation in the nature of purchase. Do you understand? Any one of the condition doesn't satisfy, then automatically it will become amalgamation in the nature of purchase. Next. Now tell me all of you, here B Limited is purchasing the business of A Limited. Now, as a result, simply A Limited selling their assets and liabilities to B Limited. B Limited should need to pay something in consideration. As a result of purchasing the business from A Limited, B Limited should need to pay something either in the form of cash for the purpose of purchase of assets as well as liabilities. Such amount is technically known as PC. We already discussed it, right? Which is purchase consideration. Now, the purchase consideration paid by the purchasing company only in the form of equity shares. Only in the form of equity shares. The PC should be paid only in the form of shares. So that means that purchase consideration should not be in any other form. That means cash, if purchasing company paid cash to A Limited, then that amalgamation will not call it as amalgamation in the nature of merger. Yes, then amalgamation, we can call it as amalgamation in the nature of purchase. But for fraction of the shares, if you want, you can give the shares. For fraction of the shares. What is the meaning of fraction of the shares, sir? For example, we valued the business of A Limited as it 5,33,333. Let us assume. Now, B Limited issuing certain number of shares, each and every share price is equal to, the value with which B Limited is ready to issue to A Limited, sir, that is at the rate of 50 rupees, let us assume. Then may know how many number of shares need to be issued by B Limited to A Limited. 5,33,333 divided by 50. How many number of shares? Quickly, all of you. I got something like 10,666.66. Guys, 0.66 share is available in the market. Is it 0.66 share available in the market? This fraction of the share not available in the market. That's why for this 0.66 shares, 0.66 multiplied with 50, I can able to pay in the form of cash. Sir, you paid in the form of cash. That's why amalgamation is not amalgamation in the nature of merger. Like that, you should not argue. Because for fraction of the share, it is not possible to issue the share. That's why for such fraction of the shares, the other company can able to issue cash. Except that the entire PC should be issued only in the form of equity shares only. Next, consider it, guys, all of you. Shareholders holding not less than 90% share capital in selling company should become shareholders of purchasing company after amalgamation. Shareholders holding not less than 90% share capital in selling company should become the shareholders of the purchasing company after amalgamation. Sir, what he is trying to telling here, sir? Now A Limited have their own balance sheet. Out of that, A Limited have the share capital. In such share capital, it is contributed by the shareholders only. Now purchasing company is going to issue PC. Now PC is also in the form of equity shares. Now due to which what happened? Automatically A Limited shareholders will become B Limited shareholders. Like that, due to issue of purchase consideration, due to issue of shares by B Limited, to that extent of at least 90% of share capital holded by the shareholders should automatically become the shareholders of the B Limited after amalgamation. Do you understand? So simply what he is trying to telling here, the majority of the shareholders of the selling company should become the shareholders of the purchasing company. Not only the majority. Majority means just more than 50%. 90% here talking actually. 90% of the existing shareholders of the selling company should become the shareholders of the purchasing company after amalgamation. How it is possible? It is possible only through by issue of equity shares in the form of PC by the purchasing company to the shareholders of the selling company. Then only automatically shareholders of the selling company would become shareholders of the purchasing company. Do you understand? Sir, in-depth issues we are going to deal in future. Just for the time being, what are the provisions I'm telling? Just make it try to understand. Once dots connected, everything you can understand. You can able to enjoy the entire session wherever you go. Okay. Now let me put the last one, which is selling company should need to, oh sorry, not selling company, purchasing company should need to continue the same line of business, as conducted by selling company previously. For example, sir, selling company previously in drugs manufacturing process. Now purchasing company should need to continue with the same line of business. Yes, they may adopt certain new drugs, but they should be in the drugs business only. But they should not be migrated to the service industry, or they should not be migrated to the other manufacturing industry. Do you understand? The same line of business should need to be continued by the purchasing company as well. If all the 5 conditions satisfied, then the amalgamation is said to be amalgamation in the nature of merger. If any one of the condition is not satisfied, then the amalgamation will automatically become as amalgamation in the nature of purchase. Now let me summarize the 5 conditions one by one quickly. Sir, when an amalgamation is said to be amalgamation in the nature of merger, sir, the first and foremost condition, all the assets and liabilities of the selling company should become the assets and liabilities of the purchasing company. All the assets and liabilities should be taken over at book values only. Purchase consideration should be paid only in the form of equity shares only. But for any fraction, the purchasing company can able to pay in the form of cash also. But it doesn't mean that the amalgamation is amalgamation in the nature of purchase. Next, come to the fourth point. At least the 90% of the share capital holded by the shareholders should become the shareholders of the purchasing company after amalgamation. Simply shareholders holding not less than 90% share capital in the selling company should become the shareholders of the purchasing company after amalgamation. Purchasing company should need to continue the same line of business as conducted by the selling company before amalgamation. Is it okay, guys? If all these 5 conditions satisfied, then which is known as amalgamation in the nature of merger. Otherwise, the amalgamation is in the nature of purchase. Fine. Now, come down, guys. Sir, till now, you explained various things, sir. What is the meaning of reconstruction? What is the meaning of internal reconstruction? What is the meaning of external reconstruction? What is the objective? Then we seen the meaning of amalgamation. We seen the meaning of absorption. In external reconstruction, really what happened also we seen. Then different types of amalgamation. You explained amalgamation in the nature of merger, amalgamation in the nature of purchase. That and all okay. In this chapter, what we are learning, sir, in this chapter specifically what we are learning, you can consider that till now what I have discussed as an introduction. Now in the current chapter amalgamation, what we are trying to learn, sir, only 3 issues we are going to learn. Concentrate, guys, all of you. My OneNote is not working. Just a moment, all of you. Yeah, fine. Now, learning aspects. Guys, in this chapter, we are going to learn only 3 things. Number 1, accounting treatment. In the books of selling company. If you take either pure amalgamation or absorption or external reconstruction, one set of companies are selling companies. Then what is the accounting treatment in the books of selling company we are going to see? Computation of purchase consideration, which plays the crucial role in the entire chapter, because whether it is amalgamation or absorption or external reconstruction, ultimately purchasing company should need to pay something to the selling company in the form of PC in a purchase consideration. Now we should need to work out such PC. Okay, how we should need to calculate the purchase consideration, what really means it, what are the different methods available in computation of PC, such all issues we are going to discuss. And finally, we are also going to learn accounting treatment in the books of purchasing company as well. That means we are concentrating only on 3 issues, guys. One is accounting treatment in the books of selling company, computation of purchase consideration, accounting treatment in the books of purchasing company. Now here my question is, for knowing all such 3 things, which standard we should need to learn? Tell me, yeah. Either for knowing accounting treatment in the books of selling company, for calculation of purchase consideration, for knowing accounting treatment in the books of purchasing company, which standard we should need to know? Tell me, guys. No one is providing answers here. Yes, 14. Am I right? Yes, 14. But that's not true. That's not correct. Because accounting treatment in the books of selling company, accounting standard 14 doesn't applicable. That is the reason why I asked. But for calculation of purchase consideration, and accounting treatment in the books of purchasing company, AS 14 is applicable. So most of the students may feel that for providing accounting treatment in the books of selling company, also AS 14 will be useful. No, not at all. Why, sir? What is the reason? In selling company, what is happening? Simply selling company going to liquidate. If any particular company is going to liquidate, then which provisions we should need to adopt? You know, closure of the books of accounts. Closure of books of accounts simply. If you close the books of accounts, automatically accounting treatment will be over. No need to provide any special accounting treatment. Sir, for closure of this books of accounts, simply what you should need to follow? GAAP, generally accepted accounting principles. I mean, at the time of closure of books of accounts, what really happened? What accounting treatment you might adopt? Not only in the form of amalgamation. For example, if you want to close your business, which accounting treatment you are going to adopt? The same accounting treatment you are going to adopt here as well. There is no special accounting treatment. Do you understand, all of you? Because in case of selling companies, if you observe, either in case of amalgamation, absorption, or external reconstruction, the selling companies are going to liquidate. The selling companies are going to liquidate. The selling companies are going to liquidate in all the 3 situations. That's why simple the liquidation provisions going to apply formally, legally. For our accounting procedure, just you should need to adopt the closure of books of accounts. For that simple generally accepted accounting principles, you can apply. That is more than enough. But for computation of purchase consideration and for providing accounting treatment in the books of purchasing company, you should need to adopt accounting standard 14, which is accounting for amalgamation. Do you understand, all of you? Yeah. Just a second. Let me check the query box. So many queries are coming. What is happening? Just let me check. Mr. Praveen, sorry, Mr. Vashishta, I'm so sorry. What he's asking, sir, if the shareholder already holds some shares in the amalgamated company, then okay. What his issue is, something I discussed related to types of amalgamation. Amalgamation in the nature of merger, amalgamation in the nature of purchase. Now, what his doubt is, fourth point, his doubt. What he is talking, sir, for example, one company A Limited is there, sir. Another company B Limited is there, sir. Now B Limited wants to take over A Limited. Now B Limited wants to take over A Limited. Now what you told, in A Limited, share capital is there. Out of this share capital, to the extent of 90% of the share capital held by the shareholders to become the shareholders of the B Limited. You told like that, right? What he is telling, before the amalgamation itself, if A Limited holded certain shares in B Limited, then what is the situation, sir? Now you should need to exclude such shares. Apart from such shares, you should need to hold the 90%. One more time, I'm repeating. Before the relationship, before existing of this relationship, if A Limited hold any shares in B Limited, can I count into that 90%, sir? No. Other than that, right now, you should become 90% of the share capital, at least need to become the shareholders of the B Limited. So any of the particular shares held by A Limited into the B Limited before amalgamation should not be make it into count. Hope that is your doubt. Am I right? That's why such shares need to be excluded. Next, one more thing. Manoj Kumar, what his doubt is, sir, the condition of same line of business to be carried by purchasing company for next 1 year only, and it can change its business after 1 year. That is depending upon the provisions, articles of association. Sir, in India, any one company have that freedom, guys. Even though with the main objective, I established a company, it doesn't work out for me after some time period, I can able to change the main objective as well by altering the memo of association. So that freedom is available not only for the amalgamating company, that freedom is available for any company. Initially, at the time of acquiring the business, it should need to conduct the same line of business. But later on, it will check whether it can able to sustain in that business or not. Do you understand? Here, the motto is, here the objective is, straight away you are acquiring the business, you are using such assets for other business. That is not allowed. That is the objective behind the prescribing that point. Okay. Super. Hope you all are with me. And you understand the difference between amalgamation in the nature of merger as well as purchase, and why in the books of selling company AS14 doesn't applicable, why for calculation of purchase consideration and accounting treatment in the books of purchasing company AS14 is applicable. Hope you understand, right? Fine. Guys, from here, we are into the real chapter. First, we are going to discuss things related to the purchase consideration. What is the meaning of PC? And as per AS14, really what it tells, things related to PC, how to calculate the purchase consideration by applying the various methods, and issues in the purchase consideration also we are going to see. Once we can able to finish the concept of purchase consideration, then only I can drag my discussion to the either accounting treatment in the books of selling company or accounting treatment in the books of purchasing company. So please, all of you, go for the break. Please take the break for the 10 minutes and assemble as soon as possible. Is it okay, guys? Please go for the break. Yeah, welcome back, folks. Something we are discussing related to learning aspects where accounting treatment in the books of selling company for which AS 14 doesn't applicable. So generally accepted accounting principles are going to apply. But for computation of PC and accounting treatment in the books of purchasing company, AS 14 is going to apply, right? Now, first let us discuss things related to PC, guys. Purchase consideration. As per AS 14, PC means amount payable by purchasing company to shareholders of selling company alone treated as PC. Amount payable by purchasing company to shareholders of selling company alone treated as PC. Now, concentrate, guys, all of you. Here, shareholders means only equity shareholders are both equity and preference shareholders are. We have two companies now, A Limited, B Limited. B Limited is a purchasing company, A Limited is a selling company. Now, amount payable by B Limited to the shareholders of A Limited. Now, my question is, the shareholders of A Limited means in that shareholder, only equity shareholders will coming into the picture, both equity and preference. Here, shareholders includes both equity shareholders as well as preference shareholders. Sir, does it mean that if B Limited is going to pay some amount to the debenture holders of the selling company, is not form part of PC? Is it form part of PC or not form part of PC? Can you please let me know the answers? Again, I am repeating, amount payable by purchasing company to the debenture holders of the selling company. Is it form part of PC? Your answers came little bit late. That is not your fault. So we are in the online mode. While reaching in the server, it take time. Okay. Please let me know this answer, guys. Now, amount payable by B Limited to the debenture holders of A Limited. Can I consider it into the PC? No. Absolutely no. Why? It is clearly given that amount payable by purchasing company to the shareholders of the selling company alone treated as PC. Now I will ask some questions. Please concentrate, all of you. Question number one. No, that is only one question, not question number one. Let me give the first point. Purchasing company going to issue 3 equity shares for every 1 equity share in the selling company. Purchasing company also issue 2 preference shares for every 3 preference shares in selling company. Purchasing company also issue 2 debentures for every 1 debenture in selling company. Now, can you please let me know, all of you, in calculation of PC or for knowing the amount of PC, can I consider all the 3 points or can I ignore any point? Can I ignore any point? Sir, point number 1, amount payable to equity shareholders. Is it form part of PC? Yes. Amount payable to preference shareholders in the selling company. Is it form part of PC? Yes. 2 debentures for every 1 debenture in the selling company. Amount payable to debenture holders of the selling company. It is not form part of PC. One more question. The question is not yet completed. Let me change the question. Purchasing company is going to issue 3 debentures for every 1 equity share in the selling company. Now let me know, guys, which components can I consider into the PC? Which components should I need to take it into the PC? All of you. Now I changed the case. So earlier we should need to ignore the third one. That's okay. Now come to the new case. Purchasing company is going to issue 3 debentures for every 1 equity share, 2 preference shares for every 3 preference shares, 2 debentures for every 1 debenture in the selling company. Can I consider point number 1 into the PC? No one is telling yeah. Can I consider debentures issued by purchasing company to each and every equity shareholder in the selling company? In new case, yes, in new case also, we should need to consider point number 1 as well as point number 2. The reason is to whom you are issuing is relevant. You are issuing to equity shareholders, then it is form part of PC. You are issuing to preference shareholders, then it is form part of PC. If you are issuing to the debenture holders, then it is not form part of PC. Now simply from this, what I want to conclude, to whom we are issuing is relevant. To whom we are issuing is relevant. What we are issuing is relevant. What we are issuing is irrelevant. To decide the PC, to whom we are issuing is relevant. To whom, if it is going to issue to the shareholders, then it is form part of PCE. If it is going to issue to other than shareholders, then it is not form part of PCE. What we are issuing is irrelevant. Sir, what we are issuing means you may issue cash, you may issue equity shares, you may issue preference shares, or you may issue debentures, or you may issue any other asset as well, guys. I don't know. Whatever the thing you want, as per the agreement, you can issue that component to the shareholders of the selling company. Then that is form part of PC. But if the same is going to issue to other than shareholders, then which is not form part of the PC. That is the point here I want to highlight. Is it okay? So ultimately, as per accounting standard 14, amount payable by purchasing company to the shareholders of the selling company alone treated as PC. Here shareholders includes both equity as well as preference shareholders. Super. Still the discussion is not yet over. PC discussion is not yet over. Please all of you concentrate here. As per our academics, different methods of PC calculation are available, but practically PC method is depending upon terms and conditions agreed in between the purchasing company and the selling company. One second. Yeah. So as per our academics, we are going to learn total 4 methods of calculations of PC, guys. 4 methods. Just a moment. Let us give more space for 2, 3, 4. Yeah. So method number 1 is lump sum method. Lump sum method. Method number 2 is net payments method. Method number 3 is net asset value method. Net asset value method. So popularly call it as NAV. And the last one is intrinsic value method. These are different methods of calculation of PC. Now, let us discuss one by one method in detail. Now, purchasing company, that is B Limited, should need to pay amount to the shareholders of A Limited, that we can call it as PC. Now, such PC, how we can able to calculate? That is actually depending upon terms and conditions agreed in between selling company and purchasing company. In fact, really. But for resolving the problems, we are unable to provide each and every terms and condition, right? So for the purpose of academics, to know the calculation of PC, different methods were given. But in the real-time scenario, in outside, what are the amalgamation you've seen and currently or in the past, they might adopted the different methods also, because the method is altogether decided based upon the term and condition agreed in between selling company and purchasing company. But here, no need to worry, no need to think about all the terms and conditions, because the limited information they are given for resolving our problems, that's why they might not confuse. But from the given information, at least you should need to able to identify which method of PC is applicable out of the existing methods. That is lump sum method, net payments method, net asset value method, intrinsic value method. Now in lump sum method, how to decide the PC? Straight away the amount is given. That is ad hoc consideration. Ad hoc consideration is directly given in the information. Ad hoc consideration means, for example, B Limited is paying 1 CR worth to the shareholders of the A Limited. How this 1 CR you derived, sir? That is ad hoc consideration, don't ask. Lump sum amount just we are giving, just we are deciding. But how we are deciding, don't me ask. Do you understand? If that is the case, then that method is known as lump sum method. Don't expect that lump sum method is going to ask in the exams, because nothing is there. Ad hoc consideration means the amount itself is directly given in the problem. Okay, fine. So whenever examiner don't want to twist on the PC, then they are directly providing the PC amount. They might twist on the accounting treatment with respect to selling company, purchasing company at that point of time. If at all, if you don't want to drag the problem much more on the PC, then they are asking PC, then they are providing information with respect to PC under lump sum method. Lump sum method means simple ad hoc consideration, just decided and provided the information in the problem. Now, how to decide the PC, sir? Under net payments method, or as per net payments method, amount payable to equity shareholders, and amount payable to preference shareholders put together we are calling as PC. So the example what we considered earlier, purchasing company is ready to issuing 3 debentures to each and every equity share in selling company. Then we know to equity shareholders of the selling company how much we are providing in the form of debentures, we know. That is how much amount you are paying to equity shareholders. Similarly, how much amount you are paying to preference shareholders also we know. So the amount payable to equity shareholders as well as amount payable to preference shareholders, if you make it total, then you are getting the PC. Sir, to equity shareholders of the selling company, you may issue cash, you may issue equity shares, you may issue preference shares, you may issue debentures. Similarly, preference shareholders of the selling company will also get in the form of cash, or in the form of equity shares, or in the form of preference shares, or in the form of debentures. Do you understand? Because altogether, purchasing company, equity, preference, debenture, cash, whatever they want, they can issue. But it should need to issue to either equity shareholders or preference shareholders. Then only we can consider it as a PC. You know that already. We are discussed something related to meaning of PC in the concept of meaning of PC itself, right? Fine. So simply that is things related to net payments method. In detail discussion will be there at the time of resolving the problems. Now, coming to net asset value method. Sir, in case of net asset value method, how to decide the PC? This is the actually most logical method, guys. Sir, anyone, if you want to buy the business of A Limited, now first you should need to provide the each and every specific value. I mean specific value for each and every asset. For example, A Limited having different assets like plant and machinery. Okay. Next, equipment, maybe trade receivables, or maybe cash and cash equivalent, something. Liabilities also it have like bank loan, debentures. For each and everything, I will assign the specific value, which is known as agreed value of the assets taken over. Similarly, agreed values of the liabilities taken over. If agreed value of assets taken over minus agreed value of liabilities taken over, then which is known as net asset value of the business, which is known as net asset value of the selling company, which is nothing but PC in this method. That means in case of net asset value method, how to calculate PC means assets taken over by purchasing company at the rate of agreed values, that is important, less liabilities taken over at the rate of agreed values. Then the difference between assets and liabilities taken over, we can call it as NAV, net asset value of the business. In this method, NAV is equal to PC. Now here what you should need to observe, purchasing company may not take over all the assets of the selling company. Which assets purchasing company ready to take over, such assets only you should need to consider here. And that too, purchasing company will consider at the book values of the selling company or at different values, sir. No. If purchasing company wants to take over at book value, then agreed value is book value. If the purchasing company don't want to take over the assets and liabilities at book values, then it may assign their other values depending upon the market valuation or depending upon their negotiation. They may assign the other values which are nothing but agreed values. At which value purchasing companies want to buy the assets and liabilities of the selling company, such values are known as agreed value. So those assets which were taken over, and that to taken over at agreed values only, I should need to consider. Similarly, those liabilities they want to taken over, such liabilities only taken into consider at the rate of agreed value. Now the difference is known as NAV, which is equal to the purchase consideration. Do you agree, all of you? NAV method, do you understand? Tell me, guys. Fine. Next, all of you please come to intrinsic value method. Please come to intrinsic value method, guys. Just a moment, guys. 1 second, please, all of you. Yeah, fine. Concentrate. Sir, coming to intrinsic value method. In case of intrinsic value method, really what happens, sir? Basically, there is no difference between NAV method and intrinsic value method. Actually, intrinsic value method as equal to NAV method, guys. As equal to NAV method. Is it true, sir? Then why different method of a PC was given? I'll tell you the reason. Just hold for some time. First of all, in intrinsic value method, how we should need to work out the PC, let us check. Please concentrate. Now, here A Limited is there. Here B Limited is there. The same company here itself is there, na? Why again I should need to write? Yeah, A Limited is here, B Limited is here. B Limited is a purchasing company. A Limited is a selling company, you know. Now, how B Limited decide how much amount I should need to pay payable to the shareholders of A Limited? How it will decide? It will decide based upon NAV of A Limited only. NAV of A Limited only. But how it will decide? NAV per share. NAV per share. NAV per share is technically known as intrinsic value per share. Sir, what are you talking, sir? Sir, here PC is equal to intrinsic value per share in selling company into number of equity shares in selling company. Simply intrinsic value per share. Intrinsic value per share means, what is the meaning of intrinsic value per share? Intrinsic value per share is nothing but total NAV of the selling company divided by number of equity shares in the selling company. Then you will get NAV per share only. NAV per share is nothing but intrinsic value per share only. But in the problem, while calculation of PC under intrinsic value method, they are not providing the information of the total NAV. Just they are providing the information about intrinsic value per share in the selling company. Then how you will get the total NAV? NAV per share, if you multiply with the number of equity shares in the selling company, then you will get the total NAV. The total NAV itself is the PC. That is the reason why a different method is going to adopt. The intrinsic value per share is as equal to the NAV per share only. But while providing the information in the problem, they are not given the total NAV. Then if they are given the total NAV, simply you can calculate PC is equal to NAV. They are given the information related to the NAV per share. NAV per share is nothing but intrinsic value per share. Then PC is equal to intrinsic value per share into number of equity shares in the selling company. Simply you will get the purchase consideration. Do you understand all of you this point? Tell me, yaar. Sir, simply under lump sum method, PC is nothing but ad hoc consideration, and under net payments method, PC is nothing but amount payable to equity shareholders and amount payable to preference shareholders. If you consolidate, if you make it sum, then you will get PC. Under net asset value method, you should need to compare assets taken over at the rate of agreed values with liabilities taken over at the rate of agreed values. Then which is equal to NAV, which is equal to PC under NAV method. In case of intrinsic value method, intrinsic value per share in the selling company they provided. Then if you multiply with the number of equity shares in the selling company, then you will get the total intrinsic value of the selling company, which is nothing but total NAV of the selling company as well, which is nothing but PC. Now, here the point is, all of you please concentrate here. Here we discussed how to calculate the PC. One second, before proceeding further, let me check certain queries are there. NAV method understood, sir. I would understand it during the question and answers. I'm not really clear. Intrinsic value method not clear. Guys, no worry, things related to intrinsic value method at this stage. Just for the time being, what you can do from your end, intrinsic value is as equal to the net asset value method. Yes, there is no difference between NAV method and intrinsic value method in my point of view as well. Sir, then you may ask a question that why again you are putting intrinsic value method, sir? That is the reason why I am telling, if you know net asset value of the selling company, that itself is PC. Please all of you concentrate. We know that under net asset value method, if you know the NAV, which is equal to the PC, that's great, super. But they are not giving the individual assets, individual liabilities, agreed values in the problem. Such information was missing. Then what they provide on behalf of agreed value of assets and liabilities, simply they are giving the intrinsic value per share in the selling company they will give. Then how I will get the NAV, sir? Sir, intrinsic value per share is nothing but NAV per share itself. Then your workload is very much less here, because no need to calculate NAV. They directly given the NAV per share. Then what I should need to do? NAV per share, simply I should need to multiply with number of equity shares in the selling company, then I will get the total NAV. Earlier, to get the NAV, what I did? Earlier, to get the NAV, I compare assets with the liabilities. Then I got the NAV. Then NAV equal to PC. But right now, what I am doing to get the NAV, I am multiplying NAV per share with the number of equity shares. Now, under the net asset value method, for knowing the NAV, I am comparing assets with liabilities. But under intrinsic value method, for knowing the NAV, I am multiplying NAV per share with the equity number of equity shares. The NAV per share itself is technically known as intrinsic value per equity share. Intrinsic value per equity share into number of equity shares is equal to again NAV only, which is equal to PC only. Tell me, yaar. Some of our friends is asking, sir, if the question is silent, which method we should need to adopt? I'll come to that point. Don't worry. whether you agreed or not, that itself is the major burden for every student. Identification of method of PC for that particular problem plays the crucial role for resolving the entire problem. Yes, I'll come to that point. Just hold for some time. Okay. Now clear, right? Got it. So that is the reason why there is no difference between intrinsic value method and net asset value method in my point of view. Under net asset value method, NAV I am deriving by comparing assets with liabilities. Under intrinsic value method, I am deriving NAV by multiplying NAV per share with number of equity shares in the selling company. That is the only difference. In both the methods, ultimately PC is equal to NAV only. Okay, fine. Concentrate. Still the discussion is not yet over. Please concentrate, all of you. Now, how I should need to identify which method is suitable for the existing problem, sir, or which method I can able to adopt in the particular scenario, how I will know. Please concentrate. First, you might read the information given in the problem. While reading the information given in the problem, if you can able to identify how much amount is payable to equity shareholders, how much amount is able to preference shareholders, then method of PC itself is net payments method. That means always you are trying to check that is it net payments method is suitable or not in the first step. You might easily aware that. For example, sir, for each and every equity shareholder of the selling company, purchasing company is going to issue this much of cash. Purchasing company is going to issue this many number of equity shares. For each and every preference shareholder of the selling company, purchasing company going to issue something like that they are giving. If that is the case, if you can able to ascertain how much amount is payable to equity shareholders as well as how much amount payable to preference shareholders from the given information in the problem, then straight away the method of PC is net payments method. No, sir. Amount payable to equity shareholders information is there. But how much amount we can able to pay to preference shareholders is missing. Then at that point of time, I unable to apply the net payments method. Then I should need to check whether net asset value method or intrinsic value method is possible or not. If assets taken over at agreed values, liabilities taken over at agreed values information is there, then I will apply the net asset value method on behalf of applying the net payments method. Instead of applying the net payments method at that point of time, I will apply NAV method. No, sir. For calculation of NAV, assets taken over at agreed value, liabilities taken over at agreed value information is missing. But for calculation of NAV, they are providing the intrinsic value per share in the selling company, sir. Then again, you can able to work out the NAV by multiplying the intrinsic value per share in selling company with the number of equity shares. Do you understand? Sir, for telling or for explaining the things which are look like very much easy, but while reading the information given in the problem, you might face certain difficulties. To resolve such all things, here itself I will provide certain information. Then your entire myths will be automatically resolved. Concentrate. You should need to tell the method of PC here. The question, please all of you participate. This is the deciding time whether you can able to identify the method of PC or not. The terms are like this. For every 2 equity shares in selling company, they are getting 3 equity shares of purchasing company. For every 3 preference shares in selling company, they are getting 1 preference share in purchasing company. Remaining balance in the form of cash. What is the method of PC? What is the method of PC? All of you, please let me know the answer quickly. Quickly, guys, please all of you participate. Still the answers are not appearing here. Please send your answers quickly. For every 2 equity shares in selling company, we are going to issue 3 equity shares. For every 3 preference shares in the selling company, we are going to issue 1 preference share in the selling company. Remaining balance in the form of cash. What is the method of PC? Net payment method, net payment, net payment, net payment. 1% told intrinsic value. That is the reason why I'm asking this question. You might surprised. Method of PC is net asset value method. NAV method. You may ask that, sir, this is cheating, sir. How it will happen in NAV method? Okay. You told that clearly. How many number of equity shares you are going to issue to the equity shareholders of the selling company? That is every 2 equity shares in the selling company, you are issuing 3 equity shares. For equity shares in the selling company, how much you are issuing, you told. For preference shares in the selling company, how much you are issuing, you told. But if you observe, I placed as remaining balance in the form of cash. Remaining balance, how much, guys? From the given information, do you able to appreciate how much amount payable to equity shareholders and preference shareholders? No. Sir, remaining balance in the form of cash means remaining balance to whom you are paying. If nothing is mentioned, the remaining balance is always payable to equity shareholders only. That means amount payable to equity shareholders you are unable to ascertain. Only part of the consideration only you are able to ascertain. Amount payable to equity shareholders in the form of equity shares you can able to ascertain. That's okay. I too agree. But remaining balance in the form of cash means how much cash you can able to pay to the equity shareholders. I don't know, sir. I don't know. What I told, when you should need to apply the net payments method, from the information given in the problem, if you able to ascertain how much amount payable to equity shareholders and how much amount payable to preference shareholders, then only you should need to adopt the net payments method. Now let me know from the given case how much amount you can payable to equity shareholders. Do you know? You don't know. Remaining balance in the form of cash, how much balance? If I provided that for each and every equity share in the selling company, purchasing company is ready to pay 3 rupees as cash, then that is the relevant information. Then you can consider it is a net payments method. That's why I unable to apply the net payments method. If you are unable to apply the net payments method, then which is NAV method itself. Then you are not providing the information related to assets taken over at agreed values, liabilities taken over at agreed values, sir. For the time being, I didn't provide it. But in the problems they provided, the assets taken over at agreed values figures and the liabilities taken over at the rate of agreed values figures. Then you can calculate the NAV. So here NAV is nothing but PCE. Now consider all of you. What will happen, you know? For example, here NAV you got 10 lakhs, which is PC. Now out of this 10 lakhs, in the form of equity shares, you know from this sentence, how many number of equity shares you are issuing and issue price is how much? Let us assume the worth of equity shares was 6 lakhs. And how many number of preference shares you are going to issue to the preference shareholders of the selling company also, you know, that is in the form of preference shares. Let us assume 3 lakhs. The remaining balance is cash is balancing figure, which is 1 lakh. Now this cash balance remaining you find out through NAV method, not through net payments method. That's why the method of PC is NAV method. For example, if something they are directly given intrinsic value per share in the selling company, then you can apply the intrinsic value. That's why you can able to apply NAV method only for this particular situation. Do you understand? Question was incomplete. Assets were also not mentioned. How can we answer correctly? That's I know. That I know, Mr. Geet. Okay. But at least without mentioning the assets and liabilities, for the remaining balance in the form of cash means at that point of time, at least you should need to know, at least you should need to tell, sir, net payments method, how I can able to apply. I too agree. I didn't provide assets and liabilities information, but no one is asking now. Simply they are telling net payments, net payments, net payments. Okay. Yeah, fine. Got it? Right. I know I cheated somewhat. Okay. Because why I'm giving this type of problems, you know, in examinations, examiner will cheat you. By seeing this, people will simply go for net payments method, or they are unable to think that which method is suitable here as well. And I think so in the one of the latest exam, they applied this logic. They applied this logic. Just they provided that the information like this, the remaining balance in the form of cash like that they given. And somewhere at the bottom line of the problem, just they mentioned the agreed values of the assets as well as agreed values of the liabilities. Then whenever reading the information given in the problem, always the student can simply thought that the method of PC is net payments method. But while working for net payments method, they are unable to ascertain the PC. Then slowly they are into the confusion mode in the exams. Then they are unable to resolve the problem further, because if you unable to calculate the PC, then you can't do any further, because the PC is the entire base, entire heart for the entire amalgamation chapter itself. Okay, fine. Sir, if the agreed value is not given, should we take book value or current market value, sir? Sir, if agreed value is not given, if market value is given, market value is the agreed value. If market value is also not given, then book value will be the agreed value. What is the meaning of agreed value? Agreed value means those assets and liabilities at which price we are going to take over. At which price we are going to take over mentioned in the problem, for the same price you should need to consider. No, sir, that price is not given, then you should need to consider the book values only. Do you understand? That also plays again one more crucial role, guys, because how they are provided the information, these assets are taken over at this price, like this they are given. Then what about other assets? If nothing is given, means other assets are taken over at book values only. Okay, fine. Fine. Still, let me continue the discussion related to the PC, guys. And the next issue is first, let me directly entering into this. No issue. Sir, PC either can be recorded at issue price or either can be recorded at par value. What is this recorded at issue price, recorded at par value, sir? If nothing is mentioned, we are always choosing PC is recorded at issue price only. First, I'll give the example, then you can understand what is this recording at issue price, what is this recording at par value. Concentrate, all of you. Sir, let us assume in lump sum method, ad hoc consideration, I told that 10 lakhs. I told that 10 lakh. Now, how this 10 lakhs was issued by purchasing company, sir? Let us assume purchasing company is going to issue in the form of shares. Each and every share market price is 50 rupees. That is, issue price is 50 rupees. Face value is 10 rupees. Then let me know how many number of shares issued as PC in ad hoc consideration under lump sum method only. How many number of shares issued as PC? 10 lakhs divided by issue price. How much? I should need to divide with issue price 50. That is 10 lakhs divided by 50 is equal to 20,000 shares. Now what I will record, what I will do, PC is equal to number of shares issued as PC into issue price 50, which is equal to 10 lakhs. Sir, that means if nothing is mentioned, always we are going to record PC at issue price only. This is nothing but issue price. Sir, if the same PC, if you want to record at par value, now PC is equal to number of shares issued as PC, how much? 20,000 into, you should not multiply with the issue price. You should multiply with the face value. Their face value is how much? Only 10 rupees. Here 10 rupees is the face value. Now 20,000 into 10, which is 2 lakhs. If nothing is mentioned, nothing means, sir, you should need to record PC at par value. If that statement is not available in the problem, you should always record the PC at issue price only. How many number of shares you are issuing multiplied with the issue price, then you are getting the PC. But if it is specifically mentioned that PC is recorded at par value only, then on behalf of multiplying the issue price, number of shares issued as PC should need to be multiplied with face value. Then in that particular circumstance, we are telling that PC is recorded at par value. You may ask one question at this stage, but I am unable to resolve the answer. I will resolve at later point of time. What is that question? Sir, if PC is recorded at issue price, then purchase consideration will be 10 lakhs. If PC is recorded at par value, then purchase consideration is 2 lakhs. How both are same, sir? Is it 10 lakhs? Do you think that as equal to the 2 lakhs? We are always need to record PC at issue price only, na? Why you are recording PC at par value? That's wrong, correct? That's correct only. Whether you are recording PC at issue price, PC at par value, the impact is same. I unable to prove that point at this stage because you should need to know the accounting treatment in the books of purchasing company as well. While discussing accounting treatment in the books of purchasing company, I will tell you how the impact is same, whether the PC is recorded issue price, whether the PC is recorded par value. Because might be you are recording the PC at 2 lakhs. But how many number of shares you got? 20,000. If you go to the outside market, the worth is 20,000 into 50, which is 10 lakhs only. Only for recording purpose only, you are work out the PC at a par value. But in the real time scenario, the PC value is again 10 lakhs only. But how the impact is same, I'm going to prove while discussing accounting treatment in the books of purchasing company. Just leave this issue for the time being. Just leave this issue. But one thing you should need to remember, if nothing is mentioned, we are always recording PC at issue price. That is number of shares issued as PC multiplied with issue price. If you are going to record PC at par value, the number of shares issued as PC multiply with the face value. Now the discussion is, sir, whether you want to record PC at issue price or PC at par value. First of all, what you should need to know, number of shares issued as PC. If number of shares issued as PC, you know, if you multiply with issue price, then you will get PC under first method, under first circumstance. If you know the number of shares issued as PC, if you multiply with the face value, then you will get the PC under second scenario. Now here my point is how to know number of shares issued as PC. Again, please all of you concentrate. I'm going to the roots of the PC calculation. Because so many number of times they are tested in different modes just to provide some pain to the student. How I should need to calculate number of shares issued as PC under all the 4 methods. Now I am going to explain. Concentrate. So one is lump sum method, right? And the other one is NAV. And the net payments method, first net payments, let me give. So net payments, NAV, and intrinsic value method. Sir, how I will get number of shares issued as PC? Only one thing, simply PC by issue price. If I know PC by issue price, then I will know number of shares issued as PC. How to calculate PC under these methods? I know already. How to calculate PC under these methods? I know. Now that purchase consideration divided by issue price, then I will know number of shares issued as PC. Now concentrate. Under lump sum method, ad hoc consideration divided by issue price. Then I will know number of shares issued as PC. Sir, if I want to record PC at issue price, multiply with issue price. No, if I want to record PC at par value, multiplied with the face value. Like that, I will get the PC. Do you understand? Next, come to the net payments method. How to get the PC? Amount payable to equity shareholders, amount payable to preference shareholders. Then I will get the PC divided by issue price. Then I will get number of shares issued as PC by the purchasing company to the selling company. Then at which value you are recording? If you are recording with issue price, then multiply with the issue price. No, sir, I am recording with the par value, then multiply with the face value. Do you understand? Next, come to the net asset value method. How to calculate the PC under net asset value method? NAV. NAV divided by issue price. Then you will know the number of shares issued as PC. If you want to record PC at issue price, multiplied with the issue price. No, if you want to record at face value, that is at par, multiply with face value. Then you will get PC is recorded at par value or PC is recorded issue price. Then coming to the last stage, all of you come to the intrinsic value method. Under intrinsic value method, how to calculate the PC first? PC calculation. Intrinsic value per share in selling company into number of equity shares into selling company divided by issue price. So divided by issue price means here purchasing company at which value issuing. If nothing is mentioned, purchasing company at which value it will issue, purchasing company will issue intrinsic value per share in purchasing company. Please all of you understand one more time. If nothing is mentioned, at which price purchasing company is going to issue each and every share issued as PC, to decide the issue price, purchasing company will work out their own value. Purchasing company at which price it is going to issue their own NAV price. Purchasing company, their own NAV price means which is intrinsic value per share in the purchasing company. If something directly given, purchasing company is going to issue at the rate of 120 per share to the selling company, then you can directly take 120. No, not an issue. But if nothing is mentioned, then purchasing company at which price it is going to issue their own price. Their own price means how it will get it price. That is NAV per share, it will work out in the purchasing company. NAV per share is nothing but intrinsic value per share only. Then you will know the number of shares issued as PC. You will know the number of shares issued as PC. Now, if you want to know the PC is recorded at issue price, then you can multiply with the issue price into issue price. No, I want to record the PC at par value, then you should need to multiply with the face value as usual. So that means if the method of PC is intrinsic value method and PC is recorded at par value, then the formula is intrinsic value per share in selling company multiplied with number of equity share in the selling company divided by intrinsic value per share in the purchasing company into the face value. Multiply with the face value. Guys, are you with me? So many issues I'm explaining. Alok is asking, sir, a sincere request, sir, you that please before the end of this class, please solve a question. I will try my level best. You can able to understand from starting off my session, even though I didn't give any gap as well, because the session is lengthy. If I'll try to resolve a problem, we can able to miss out something, some concepts. I mean, without knowing some concept, we are unable to resolve the problem as well. So many ambiguities will coming into the picture. That's why don't worry. Finally, if it will happens in today class, I will try to resolve. Otherwise, I will make it resolve in tomorrow. But definitely we will resolve certain number of problems which provide the clarity what are the things we discussed till now. Just in the theoretical mode only we are discussing. At least for such theoretical mode, conceptually if you can able to visualize, then I will connect each and every concept to the respective problem. Okay, sir, finally, what you are trying to tell, sir? Sir, method of PC not only decide the amount of PC, sir. Such PC, whether you are able to record it at issue price or such PC, whether you are able to record at face value, will also decides the amount of PC. Even though you are able to calculate amount of PC by applying the issue price, if ultimately you are going to record the PC at par value, then you should need to work out the number of shares issued as PC multiplied with the face value at that point of time. For example, if this part is not there, then no need to think about number of shares issued as PC. Really, whatever the PC you are calculating, that PC is the final PC. That PC is worked out at issue price only. But if something is given that PC is recorded at par value, if this is given, PC should need to be recorded par value, then at that particular scenario, you should definitely need to work out number of shares issued as PC. That is PC divided by issue price, you will get number of shares issued as PC. Then you should need to multiply with the face value. Now, number of shares of issued as PC, how I will know? In lump sum method, ad hoc consideration divided by issue price, I will get the number of shares issued as PC. In case of net payments method, amount payable to equity and preference divided with the issue price, then you will get the number of shares issued as PC. In case of the NAV method, NAV divided by issue price, you will get the number of shares issued as PC. Under intrinsic value method, how you will get number of shares issued as PC? Intrinsic value in selling company multiplied with number of equity shares divided by intrinsic value per share in the purchasing company, then you will get the number of equity shares in the, number of shares issued as PC. For all the methods, if you multiply the face value, then PC is recorded at par value. If you multiply the issue price, then PC is recorded at the issue value. That's it, guys. One more, our friend Dhyanesh is asking, sir, if the PC is at issue price, then what is the relevance of these formulas? The same thing just now I told, my dear friend. Sir, if PC is recorded at issue price, then no need to work out. You can directly work out in this method. No need to check how many number of shares issued as PC. No need to check out, because the PC what you are getting in this method itself is PC is recorded issue price. For example, in this formula, if you multiply with issue price, again issue price cancel, then ad hoc consideration itself is PC. The same thing I already told you now, there is no relevance. When if PC is recorded issue price, then if you calculated PC under above methods, which is final. In fact, you are calculating in each and every method by applying the concept of issue price only. Without knowing you already calculated the PC by applying the issue price only. But when the relevance will come into the picture, if in the problem, if they asked that PCs need to be recorded at par value, then if you calculate the PC under this method, then that's not correct. Then you should need to calculate the PC first under that method. Then you should need to divide with the issue price. Then you will get the number of equity shares issued as PC. Then you should multiply with the face value. Then you will get the PC is recorded at par value. That is my point. What I want to try to establish here, if you want to record PC at issue price, no need to check all these things. In the simple mode, whatever the method is given, in that method simple, you can calculate. That itself is PC is recorded at issue price only. But in the problem, if he twisted that PC is recorded at par value, then what I should need to do? First, I should need to calculate the PC in the normal mode. Then after that, I should need to divide it with the issue price. After that, I should need to multiply with the face value. Then only I will get PC, which is recorded at par value. That is the point I want to try to tell here. Is it okay? Sir, it means it is useful when we record PC at face value. Absolutely, my dear. Now you are with me. Absolutely. Absolutely. Correct. That is only useful when you are going to record PC at a par value. Correct. Next, any other doubts, sir? Who calculated PC? Selling company or purchasing company? The PC valuation provides a significant role both accounting while providing accounting treatment in the books of selling company, accounting treatment in the books of purchasing company. Who will calculate the PC, sir? Ante both the persons will calculate the PC according to the problem. I mean to say, who will decide the PC, sir? Based upon the terms agreed in between selling company and purchasing company. Both will sit, both will negotiate with each other, because to provide the accounting treatment in the books of selling company, I required PC. To provide accounting treatment in the books of purchasing company also, I required PC. Who will calculate this PC, sir? As per the requirement, as per the problem, as per the information given in the problem, to whom it is required, that person will calculate the PC. For example, in a single problem, we should need to provide accounting treatment in the books of selling company as well as accounting treatment in the books of purchasing company. Then only one time we will calculate PC. The same PC we are using in the books of selling company as well as in the books of purchasing company. But always it is highly useful to whom, sir? Purchasing company. It is useful to selling company as well. Why, sir? I will tell you whenever discussing accounting treatment in the books of selling company, whenever I'm dealing accounting treatment in the books of purchasing company as well. Just to hold for some time. First of all, let me know, all of you guys. Just please, all of you, let me know quickly with your answers. Sir, first these 4 methods of PC, do you able to understand or not? Lump sum method, net payments method, net asset value method, intrinsic value method. Under each and every specific method, how to calculate PC, whether you can able to understand or not. And if a particular circumstance coming to the picture, which method of PC I should need to able to apply. Do you understand? Just a second, guys. Please, all of you. Just a second. Yeah, right. Sorry for my inconvenience. Yeah. Next. Do you understand if PC is recorded at par value, how I should need to work out? Sir, PC is recorded at issue price. No need to think. Just leave it. PC is recorded at par value. How I should need to think? Do you understand? I mean, number of shares issued as PC should be multiplied with the face value. That point you should need to understand. Am I right? If these 3 points, if you have the clarity, then you can easily calculate the PCR. While I'm taking the problems, you can easily understand. Again, I'm repeating which 3 points you should need to remember. Number one, which method of PC is suitable? Which method of PC is suitable for that problem? You can able to identify. Once you can able to identify the method of PC, in that particular method, how to calculate the PC? Super. I identify method as well. Then after that, at which price I am going to record? At which price I am going to record? At which price means, sir, if it is at issue price, then second step is enough. No need to come to third step. If the shares are, if the PC is recorded issue price, then itself is the again PC. But if the PC is recorded par value, then what you should need to do? PC which was calculated under method number 2 divided with issue price. Then you will get number of shares issued as PC. It should be multiplied with face value. If you understand these 3 points, then wherever you go, you can easily find out the purchase consideration. Now let me know, guys, is it clear? Can I go forward? Can I go forward? Is it clear? Yeah, Danish, you are right. Whatever the formula you put in the query box, that's absolutely correct. Guys, can I forward? No one is providing any answer. Clear. Super. Okay. One second, guys. Let me open the material. This is our main material, guys. Sir, what are the things discussed till now? Just have a quick look. Then you might got certain confidence as well. Sir, we discussed something related to meaning of reconstruction, right? When a company has been making losses from several years, then the financial position does not present a true and fair view. So at that particular scenario, what will happen? There is a overvaluation of fictitious assets and certain unrepresented intangible assets will also be there. Such a situation will lead to higher net worth by showing a higher net worth by not depicting a true picture of the financial statements. In that particular situation, we can go for reconstruction or reorganization of the existing affairs. Based on that, reconstruction is divided into 2 types: internal reconstruction, external reconstruction. Internal reconstruction, we all together going to deal in separate chapter, which is the next chapter. 232, section 232 of Companies Act are dealing with internal reconstruction. Coming to external reconstruction, now we are dealing in the chapter amalgamation. So external reconstruction, I told you, which is classic example for amalgamation in the nature of merger as well. Sir, really in case of internal reconstruction, what happens, sir? It is a process by which affairs of the company are reorganized by revaluation of assets and reassessment of liabilities by writing off the losses already suffered. Now, through the process of internal reconstruction, we are achieving certain profits. Out of such profits, we should need to make it set off P&L account debit balance. Sir, unrepresented intangible assets, overvaluation of assets, all such things we should need to set off. Then automatically financial statements will show it a true and fair view manner. Sir, how that is possible? How we are attaining such profits? The object of reconstruction is usually to reorganize capital or compound with the creditors so that the company can be bailed out of from the present situation without winding up the existing company. How we attain the profits? Profits it is attaining through making certain compounding activities with the creditors or by making certain sacrifice by the shareholders as well. In detail discussion will be there in that specific chapter. Now coming to external reconstruction, what we deal, guys, in case of external reconstruction. In external reconstruction, altogether the existing company is going to liquidate. A new company is going to incorporate. The same thing was given. It is an undertaking is being carried on by a company and is in substance transferred to another company, not to an outsider, but to another company consisting substantially the same shareholders, with a view of being continued by the transferee company. Such external reconstruction is essentially covered under the category amalgamation in the nature of merger. We already seen in case of amalgamation, absorption, external reconstruction, how it will different to each other and what are the objectives behind such process as well. So here certain differences was given, just to outline only we are seeing. Sir, liquidation, internal reconstruction, no liquidation. External reconstruction, liquidation will happen. Reduction of capital. Sir, capital will be reduced in case of internal reconstruction because certain amount will be sacrificed by the shareholders. In external reconstruction, there is no reduction of capital. In fact, issue of capital will be there. Sir, legal position. Sir, in case of internal reconstruction, it is dealing by section 61 and 66. I think so here, wrongly quoted. This is section 232. This is section 61 and 66. Okay. So the same thing were given related to sections as well. Next, legal formalities. Sir, court approval is mandatory in case of internal reconstruction or external reconstruction. I told you at the beginning of my session, court's confirmation is required in case of internal reconstruction, but in case of external reconstruction, no court approval. Without the approval of the court, we can go. Next, we seen the meaning of amalgamation. Sir, in case of amalgamation, two or more companies join to form a new company. So then which is known as pure amalgamation. Absorption is nothing but blending of one by other company. So two companies are there, A Limited and B Limited. Just B Limited want to take over A Limited. That's why blending of one by other is known as absorption. But for the purpose of providing accounting treatment, amalgamation includes absorption as well. That point also we've seen. Next, in amalgamation, what we are going to learn, that is only two companies are there. One is transfer company or transferee company, vendor company or vendee company, or selling company, purchasing company. Whatever the thing you can call, the concept is same. So examples were given. This is pure amalgamation example. This is pure absorption example. This is external reconstruction example. We already seen through our OneNote. Next. Sir, difference in between amalgamation, absorption and external reconstruction. I already gave, just for the meaning sake only I am reading. Two or more companies are wound up and a new company is formed to take over their business, which is pure amalgamation. In case of absorption, an existing company takes over another existing company. In case of external reconstruction, a newly formed company take over an existing company. Guys, the objective in case of amalgamation and absorption is different, and the objective in case of external reconstruction is different. Am I right? The objective in case of amalgamation and absorption is to avoid the competition or to get the other benefits. But in case of the external reconstruction, the objective is to show the financials at true and fair view. That's it. Then we seen the types of amalgamation as well. Amalgamation is in the nature of merger. Amalgamation is in the nature of purchase. When an amalgamation is said to be amalgamation in the nature of purchase, all the assets and liabilities of the selling company should become the assets and liabilities of the transferor company. Next, all the assets and liabilities should be transferred at book values only. Shareholders holding not less than 90% of the share capital should become the shareholders of the purchasing company. The consideration should be only in the form of equity shares only. The business of transferor company is intended to be carry on after the amalgamation by the transferee company. Here it is given no adjustment should be made to the book values. This is actually second point we deal. All the assets and liabilities should be transferred at book values only. In simple terms, I dealt in OneNote. Here in detailed way, just they gave. Next. If any one of more of the conditions are not satisfied, then amalgamation is said to be amalgamation in the nature of purchase. So differences also the same point, just they give, no need to read. Come down. Then problematic topics, actually three topics we are going to cover. One is calculation of purchase consideration, and the other one is accounting treatment in the books of vendor company, accounting treatment in the books of purchasing company. For this, generally accepted accounting principles are applicable. For PC calculation and accounting treatment in the books of purchasing company, AS 14 is applicable. Then we started discussing things related to purchase consideration. What exactly the meaning of purchase consideration as per AS 14? Aggregate of the shares and other securities issued and the payment made in the form of cash or any other assets by the transferee company to the shareholders of the transferor company alone treated as purchase consideration. In simple words, it is the price payable by the purchasing company to the selling company, that is transferee company to the transferor company, for taking over the business of transferor companies. The important point to be noted here is the amount paid towards the equity shareholders and preference shareholders is only considered as a part of the PC as per AS 14. Hence, it should be noted that purchase consideration does not include the sum which the transferee company will directly pay to the debenture holders or creditors of the transferor company. Only amount payable to the shareholders of the selling company alone treated as PC if you are making payment to any other party like debenture holders or creditors, etc., which is not form part of PC. Then we see in the methods of purchase consideration, lump sum method, net payment method, net asset value method, intrinsic value method. Under lump sum method, which is the ad hoc consideration, the lump sum or the fixed amount just they are directly given. In case of the net payment method, individual payments made to the equity shareholders and preference shareholders, they are given. Based on that, we should need to work out the PC. In case of the net asset value method, so the purchase consideration is arrived based on the value of the assets less value of the outside liabilities taken over by the transferor company. As per AS 14, the value of the assets and liabilities shall be at the values agreed between the two parties. That's why assets taken over at the rate of agreed values less liabilities taken over at the rate of agreed values. Difference we can call it as NAV, which is equal to the PC. Then coming to intrinsic value method, purchase consideration is equal to number of shares in the transferor company. That is simply number of equity shares in the selling company multiplied with intrinsic value per share in the selling company. If number of shares issued as purchase consideration by transferor company, how to calculate number of shares issued? How to calculate number of shares issued? For which purpose is it useful? Whenever the purchasing company want to record the PC at par value, then we should need to calculate number of shares issued as PC. In any method, the number of shares issued as PC divided by issue price. Now under intrinsic value method, PC is nothing but number of equity shares in the selling company into intrinsic value per share in the selling company divided by intrinsic value per share in the purchasing company. We already discussed. If you multiply it with the face value, then you will get PC recorded at par value. That purpose this formula was given. Okay. So here itself is given meaning of purchase consideration recorded at par value. Number of shares issued as PC into issue price is the normal mechanism. Number of shares issued as PC into face value per share, which is PC recorded at par value. So both was just given. That's it, guys. Up to this part we discussed in this class. So in material also, just now we've seen what we have discussed till now. Sir, in next class, what I will do immediately, we are taking accounting treatment in the books of selling company. Once I can able to provide the accounting treatment in the books of selling company, then we can take a big problem where it involves calculation of purchase consideration as well as accounting treatment in the books of selling company. Then whenever you have any doubts, then all such doubts are going to resolve through such problem. Is it okay to all of you guys? All clear, right? Till now? Okay. Bye-bye. Enjoy. Please, all of you attend for the next session without any fail, because even though if you listen this session, if you are unable to attend for that session, then the connectivity issues will be there. You may not connect the subject properly. Bye-bye, guys. Hope you are enjoying my session. And please, all of you, make it download the material which I provided in the material corner, which I placed right now through PDF as well as the solution material as well. So one more thing, this copy is there, right? What is this copy? This is my written notes. This will be uploaded near soon. This may not be visible to you at right now. Okay. Bye, sir.